I just wanted to state here that, one of the reasons we've increased capacity is to make sure we bring down customer waiting time. We're already beginning to see that. And this chart was created in an era when customer waiting time was very high. That era, we think, is behind us as we've increased capacities. This is the last time you will see this chart for some time. XUV 700, I just want to take a couple of minutes. Many people had thoughts and questions. So what happened? And why did we do an anniversary offer at this time? We had increased prices on the top two variants between 3.8 lakhs to 4 lakhs. So this was the extent of increase. Commodity prices had gone up a lot in the period since we launched 700. There was escalation and a shortage in chips availability, which had led to increased material cost, and 700 had a lot of chips. We've increased the capacity over since launch. So we started at 3,500. We hit 6,000 capacity. Now we're at 10,000. So there is a need and a desire to start leveraging our capacities. Overall, our costs have come down for two reasons. One is, we of course done value engineering. Post-launch of a new product, we spend effort in removing extra costs which may not be adding value to customer. And as I mentioned earlier, we normalized the premiums that were there on chips at one point of time has all gone away. There's no chip shortage now. We don't have to pay any extra market price for that. So that's brought material cost down. We expect this anniversary offer to have minimal impact on financials because we expect higher volumes. We expect the costs have already come down, and we will get operating leverage out of the higher volumes. Our bookings in the month of July have gone up over 40% on 700 compared to the previous month. So we're already seeing very good momentum come out of the actions that we've taken. On the LCV side, the industry continues to be flattish. We've gained market share, so our volumes have grown a little. But hopefully, as we get into the second half, we will start seeing the segment industry grow compared to what we've seen in the last 18 months. Last mile mobility, we continue to be number one. The very interesting thing here now is that in this segment, EV penetration is at 20%. So it's the most penetrated segment with electric vehicles. As we had mentioned earlier, we expect that as new players come in, the penetration will improve, the category will grow faster, and that is exactly what we see happening here. So the auto consolidated revenue grew 16%, and PBIT grew by 45% to absolute number of 1,787 crores. The auto margin, I think, is really the highlight on the auto business for us. We have been talking about margin improvements and giving some kind of a guidance on the direction. We're very happy that we've got to 9.5% margin. Some of you had in mind, the 3XO launch that was happening in Q1, and what would that do to our margins. And some of you who were at the launch did ask us, how are you ever going to be able to finance these kind of prices that we launched at? Well, 9.5% answers that question. With that, I'll hand over to Amar. Thank you.
Thank you, Rajesh.
Okay, Shali, that was the management that we've seen for M&M talking about their numbers, the outlook of the company going forward as well. We will keep you all more updated with what is happening. As of now, M&M stock has fallen from the day's highest point. It's still holding on to gains of almost 2% as of now. 2,951 is what M&M is managing to trade at. But let's move on and keep it going with the stocks that have been buzzing in trade. And the next one that we should be highlighting is V2 Retail. Reported a very strong set of numbers this time around in Q1 FY25. Strong revenue growth, mainly driven by sturdy move coming in from the same-store sales growth of the company. That was at by 37% SSSG growth. Volume stood at a growth of around 55% on a year-on-year basis. They added 10 new stores crores during the quarter. So keeping an eye on that. Gross margin, slight bit of a contraction that came in over there. So watching out for that one. While overall the EBITDA performance that grew by 56%, coming in at 55 crores. So strong numbers, and looking at the stock right now as well, locked in upper circuit. So clearly the street is giving it a thumbs up.
All right, let's talk about another company that is in focus in today's trading session. We don't talk about this one much, and it is Kopran, because that particular counter saw an uptick of as much as 2% on an intraday basis. This company is an integrated pharma company, and they said that they've got the environmental clearance from the government to manufacture synthetic organic chemicals. They're saying the approval is to make synthetic organic chemicals up to 97 metric tons per month at the company's Gujarat unit. They also said that this is going to be beneficial for the company, and therefore the stock is up for 6 consecutive sessions.
Okay, surely keeping an eye on that one, but let's also bring on board Ashish Kyal on the technicals. And Ashish, good afternoon, and thank you so much for joining in with us. Polycab, that's the first stock that you've picked out for us. What a move that it's already seen in 6 months, almost 50-60% uptick. What's the word now one could have, or what is the target that one should be keeping an eye out on Polycab?
Hi, afternoon to you and all the viewers. If you look at Polycab, I think the stock has shown the dip towards 6,000, and from there showed a very strong bounce back on the upside. The trend remains positive. We can expect it to reach towards the 52-week high again at the levels of 7,400. So that's the target for Polycab, on 7,400. And on the downside, 6,490 remains an important support.
All right, so that is all about Polycab. Then Dixon Tech, Ankita, why is this stock in focus?
Well, yes, Dixon Tech is in focus on the back of its results, and good set of results coming in. In fact, the profit has doubled, and the revenue is also the revenues has doubled, and in fact, profit is more than doubled. Revenue is up 101% on a year-on-year basis. PAT has also come in at 139 crores versus 67 crores year-on-year, up 108%. Their margins have, however, have seen a downtick. Their margins have contracted by 20 basis points, and the EBITDA has come in at 248 crores versus 132 crores on a year-on-year basis, an uptick of 88%. Goldman Sachs also came out with a note on Dixon, and they're maintaining a sell, but they've hiked the target price to 6,740 rupees. Now they're saying that the mobile ramp-up is pretty strong. Cash generation is still muted, but the commentary is positive and higher value addition and increased capability building in the mobile phones. Now they're concerned on low margins and low operating cash flows, and that's why they're maintaining a sell on Dixon. But good set of results coming in for Dixon. It's trading with gains of 1.5% right now.
Let's move on and talk about a stock that is trading at a multi-year high, and that is Trent. Ashish, there's no stopping this in terms of an up move. Just last 1 year, from 2000 today, it's trading at 5,800. So 200% to 30% uptick. Is it time now to finally book profits, or could we expect this run-up that we're seeing in the last few years to still continue for Trent?
See, Trent is still trading at 52 weeks high. It's touching that 5,800 level, and there is absolutely no slowdown in momentum. So I would suggest to continue to trade in the direction of the trend, which is positive, and we can expect a target of around 6,500 on this stock. Any dip from here can be used as a buying opportunity for 6,500 or higher. And on the downside, the support of the 10 days average comes to around 5,500 level.
So that is all about Trent, Ashish, but also UPL. How is this one looking on the charts to you? Because this particular counter has been a bit of a disturbing point or a pain point for some of the investors, isn't it? Given the fact that the UPL at one point in time shows a scope of recovery, and then that doesn't transpire the way it should transpire. What's your take now for UPL?
Yes, I completely agree that there can be some patience that investors might have lost on this stock. But if you look at it, from around 580, it's corrected towards 530, and we are now seeing a very strong recovery on the upside towards 571 level. So I think the overall stock can be just starting to give a strong breakout. Trend remains positive. Upside target as per the pattern is 620, and on the downside the support is at 560 level. So the risk reward looks very appealing for 620 as the target, and one can create long positions here.
An eye out on those levels over there for UPL. Let's move on. And IndiaMart, that's the one we are focusing on. numbers, when you look at it in terms of the EBITDA margin front point of view, yes, it's not a bad set of numbers on that front. But what was the pain point, or what's the concern that still comes in for IndiaMart is the high churn. That is continuing to be a concern for the company. It's been a concern in the last few quarters, and that is the concern coming even now, that high churn is continuing. That is what even brokerages are highlighting in terms for IndiaMart as well. So yes, when you're watching out, and what Nomura is also saying, that this high churn is something that they're watching out for. Management also highlighted that they cannot give a guidance for that because the situation is still sticky, and the paying subscriber addition was quite muted this time, and it was down 70% year-on-year basis and 40% on a quarter-on-quarter basis. So that's a big concern that is highlighted even by brokerages. The management themselves is also highlighting this situation, that yes, that's still a sticky situation. Though tailwinds coming in for EBITDA margin point of view, the reported EBITDA margin, they are seeing tailwinds. There is no change in estimates by Nomura in terms for IndiaMart Intermesh. They are seeing the target price at 2,520 rupees per share with their neutral rating. As of now, the stock is down 6.35% in trade. Those concerns around churn is surely a big issue, and the street is also not too happy.
All right, so that's about Shahi Glass. Let's just figure out if we have to. Sorry, I beg your pardon. The Shahi Glass is flashing on the bottom of the screen. That was all about IndiaMart. But also you have Anish Shah, who is actually speaking at the M&M press conference. Let's see if we can cut across to that, because he is. All right, we'll get back to that, because he is responding to the commentary coming in from, or the queries coming in from ET Now. But on that note, we'll slip into a break on this edition of Market Fatafat. When we come back, more stocks to discuss. Don't go anywhere. Welcome back. You're watching Market Fatafat on ET Now. Let's continue with the stocks that are moving in trade. And TCPL, that's the counter that you've picked up, Ankita, and reacting on its earnings.
Yes, absolutely. Tata Consumer Products is an earnings candidate. In fact, largely in line set of numbers. However, there was a decline in the net profit, even though the brokerages are giving their bullish view. Let's take a look at the numbers first. Then, revenue saw an uptick of 16.3% on a year-on-year basis, largely in line with what we were expecting. The margins also, were up 70 basis points. EBITDA also an uptick of 23%, in line with what we were expecting, but the net profit saw a decline of 8.3% on a year-on-year basis. The India beverage segment grew 6% with flat tea volumes on a year-on-year basis, and the India food revenue was up 30%, and the volume growth was at 10%. Now, Goldman Sachs also came out with a note. They're maintaining a neutral with a target price of 1,086 rupees. They feel that it was a muted quarter one. A domestic business offset was by strong international margins. Domestic tea and ready-to-drink beverages delivered weak growth, but food businesses had a stronger quarter. Motilal Oswal is also maintaining a buy on the counter. They're keeping their target value intact for 1,380 rupees per share, and also Citi maintaining a buy on the counter with 1,248 rupees. So that's the word coming in for Tata Consumers.
Okay, that is Tata Consumers. Let's move on, talk about HDFC Life then on the charts. And HDFC Life today surely is buzzing in trade, but also in the last 6 months has seen an uptick of almost 24%, Ashish. Especially in the last 1 month, you could say that uptick is coming in the most. What's the word for HDFC Life, and what is the target that one should be keeping?
HDFC Life has shown an impulsive rise from an Elliott Wave perspective, so the overall trend is positive. If you check, it has managed to break its previous high of December also and sustaining that. So the overall trend looks positive. Any dips from here should be used as a buying opportunity. We can aim for the targets of 750 on the upside. 750 is the target. One can aim over near term. And on the downside, one can maintain a stop loss of 695 levels.
Let's talk about Zydus Life. Then that particular counter is in focus in today's trading session. It saw an uptick, a mild uptick rather, of about 2% or so. The company has gotten approval from a Mexican regulatory authority to actually market their cancer drug, which is Mamitra. The drug is to be used for the treatment of patients with breast as well as advanced gastric cancer. So on back of that, you saw the stock see an uptick of as much as 1.5% or so. Now it's actually near the day's highest point, 2.3% uptick coming for Zydus Life, gaining for a third consecutive month, actually 16% so far in the month of July. Zydus Life has logged in gains.
Okay, let's move on to the next stock. And Ankita, the next stock that you picked out for us is Castrol. This one also an earnings candidate?
Yes, Castrol India is also an earnings candidate for quarter two, because they they take the calendar year. So for Q2, Castrol has posted its results, and if you see the results, the revenue is up 5% on a year-on-year basis. We did also see an uptick of 3% in the profit. The margins, however, saw a contraction of 10 basis points, coming at 23.1% versus 23.2%. Marginal difference there. The EBITDA saw an uptick of 4%, coming in at 323 crores versus 310 crores in a period a year ago. So that's the result coming in. Clearly, the street has given it a thumbs down. It's trading with cuts of 2.5% right now.
Okay, let's move on and talk about the next stock. We have 5-star business that's also in focus on the back of its numbers. A good set of numbers that came in from the company. 483 crores is the net interest income versus 368 crores, which is up 31.4%. The profits of the company also seeing a good growth, coming in at 252 crores versus 184 crores, which is up 37%. So all in all, what we're seeing is we saw that spike up coming in for 5-star when the numbers were reported. Look at it. But then, yes, given up again those gains, keeping an eye out on 5-star business. As of now, it is trading with cuts of almost 0.3% in trade.
All right, let's talk about Colgate-Palmolive then. Ashish, this one saw a good move on back of its earnings, but what's your take on the charts then? Do you think the good move will continue for Colgate?
Yes, I think the overall FMCG sector should do well. The defensive space should be outperforming now, and Colgate is the outperformer within the defensive space. So looks like the sustainable rally is here to stay for the stock also, and we can expect a move towards the level of around 3,800 on the upside, and on the downside one can maintain a stop loss of 3,300. So the risk reward is very appealing even for creating long positions at current levels.
Okay, Charlie, keeping an eye out on Colgate-Palmolive there. But let's move on to the next stock. And Ankita, you have picked out Naveen Fluorine for us. This is also an earnings candidate.
Well, yes, Vinny, Naveen Fluorine is an earnings candidate. In fact, if you look at the results, not a great set of results coming in there, but the revenue is seeing a downtick of 13% on a quarter-on-quarter basis, coming at 524 crores versus 602 crores. The net profit also saw a decline of 27% sequentially. The margins, however, were up 88 basis points on a quarter-on-quarter basis, and the EBITDA saw a downtick of 8%, coming at 100 crores versus 110 crores in the previous quarter. So that's where Naveen Fluorine is at. Currently, it is trading. We did see a downtick in the morning, but it's picked up from there, and currently it's trading with gains of 0.6%.
All right, moving on then. Ashish, let's talk about Balkrishna Industries then. How is this one looking on the charts to you?
See, Balkrishna Industries was consolidating over past 2 or 3 weeks of time, and about 3 days back it showed a very strong breakout on the upside. I think over here there can be short-term consolidation, but the up move should resume, and we should eventually reach towards the level of around 3,750 on the upside. So the trend remains positive over here in Balkrishna, and on the downside one can maintain a stop loss of around 3,260 levels.
Keeping an eye out on those levels over there for Balkrishna Industries, surely one to keep an eye out on, Sharon.
Absolutely. Apart from that, keep an eye out on Zaggle also, because that's one is extending the gains after the upbeat Q1 earnings. Today, the stock is trading higher by about 1.6%. One point in time, it's trading higher by about 2.5% or so. Remember, in the previous trading session, the stock has seen an uptick of about 5.2%, gaining for a 6th consecutive session. They had reported a very extremely healthy set of profits, consolidated profit coming at around 16.7 crore rupees, while their revenue more than doubled on a year-on-year basis. So on back of that, the stock is continuing its run on back of strong earnings.
Surely keeping an eye out on Zaggle as well. But with that, we're absolutely out of time on this edition of Market Fatafat. So thank you so much, Ashish, Sneha, as well as Ankita for joining in with us. And it's a goodbye from Cheryl, myself, as well as the team who put this show together.